And good morning, and we are live. Good morning, and everyone who's catching us today on Behind the Markets. I'm your host, Munyumba Mutwale. I will be eventually joined by Vernon, my co-host. Unfortunately, we're just having a little bit of a glitch with sound. You may have to bear with us for a second. Um, you may have to bear with us for a second as we try and get our things stabilized out for a bit. But yes, good morning to everybody who's catching us today on Enterprise Thursday. You're going to really enjoy today, and it is the post Bank of Zambia announcement session. There are a few things that did actually come out yesterday of yesterday's meeting, which are of importance to all who are budding investors and budding entrepreneurs, and which way you decide that you want to try and fall on this. But once again, a good morning to all. Let's get started and let's get in. Right, in today's market roundup, we did see, as I said, please, once again, tell your friends about this, tag your friends, give us a comment of where you are, what your name is, and who you are, where you're joining us from. Right, giving us today's market roundup, we are seeing that the Kwacha has continued its death spiral slide down to 18.60 on the interbank rate, down 0.3% as of yesterday. We did also see that we saw a 1.64% movement down and a 4.8% movement down in the last 30 days. Kwacha is the dollar is in an upward movement trajectory, and it's kind of passing through the hold phase, and it's getting closer and closer to being a strong buy. As you can see, its directionality and its buying case. Stock market has been frozen still for over a week at 1,850 after results season has pretty much come to a conclusion. All the dividends announcements have come to a conclusion. Everyone is still trying to wait as to the trajectory of the country. As you can see, the bond market has continued along its way, up 0.1% yesterday, down 0.2% in dollars, and the interest rates are still stuck somewhere between 23.996%, and they're moving very slowly through that patch. Other currencies we are seeing is that the rand is moving about 0.9659. As you can see that the rand moved down, so it's at 0.9659, so it's just showing you that African currencies in union are actually getting weaker against the US dollar, because you can see there's no breakaway between the rand and the kwacha. The kwacha and the rand have actually been holding quite a stiff pattern, as the dollar is up 4.8% in the last month. The rand is down actually 1.23% in the last month, showing you that it's really been dollar strength that's actually been pushing the currency, or Africa currency weakness. That's been the main thing that's been driving the losses that have been occurring on the market. And that's been driving all of this. You can see this across many African currencies. They're getting hammered. Emerging market currencies are managing to come out stronger, but African currencies are taking a beating during this session. As you can also see, we're also picking up here in terms of year-to-date returns, 10.5% in terms of bonds. And in terms of on the US dollars, bonds up 7.5%. Remember, we're prepping for an auction. Interest rates are starting to slide down. As you can see, they've been on the downward tear, showing us that we're actually having stronger buying happening in the bond market in general. Commodities market is showing that copper did bounce back up about 2.29%, oil up 1.18%, while gold went down. This is all on the backs of debt ceiling talks. Debt ceiling talks did actually bring some optimism, some progress being made in debt ceiling talks between Speaker Kevin McCarthy and President Joe Biden on where to come up on extending the debt ceiling. And there are some terms that the Republicans are putting forth. But remember, the 1st of June is still the deadline that everyone is trying to reach. Now, in terms of your wealth insurance assets, we are seeing that yesterday we did see them also go down along with gold, 0.8% down in Bitcoin, went back down below 500,000. Ethereum down 1.2%, and gold down 0.4%. So as you can see, there is a bit of risk on trading starting to happen around the world. You could also see it in the US stock market. So people are willing to look at risk again. Now, if you're looking at the cross board again, we haven't seen much movement. It's pretty much the same as where it was yesterday. But we are still seeing gold up 11.8% as the leader of the mainstream assets. In real terms, 5.7%. USD down 3.3% in real terms. Stocks up 5% in real terms, with bonds up 4.4% in real terms. So we are seeing kind of this whole stretch, and the crypto assets still leading, but that's mainly because of the super run they had at the beginning of the year. Remember, they edged off. Bitcoin at one point was 98% up year to date in the last 30 days. in the last 30 days, these are all in the red. Bitcoin is down 4.8% in the last 30 days. Ethereum is down 9.24% in the last 30 days. So you can see that the mainstream assets are the ones which have been performing over the last 30 days. Now, taking a look at our four horsemen, we did see that U.S. crude inventories did rise 5.04 million barrels. That should have pushed oil prices down, but it was the debt ceiling talks that pushed risk traders back into holding oil. While EU inflation remains stubborn and sticky, it's still stuck exactly where it was, only moving about a 0.1% away from where it was in the last month. You're seeing 5-year UK interest rates auctioned lower, with 10-year bond rates in Germany also auctioned lower. However, 20-year bond rates in America auctioned higher, with US mortgage rates coming higher. So you're getting mixed reads on higher interest rates in some areas. Italian trade balance did jump up 7.5 billion unexpectedly, while South African retail sales also continued to slow down. U.S. housing starts did rise, but some of the worst news came in the fact the Japanese industrial production and capacity utilization has come down, meaning Japanese factory activity is on the low, is starting to decline, is continuing to decline, while you're seeing new car registration in the UK, Italy, and Germany all slow down, with US mortgages also going into a slowdown along with building permits. So you are still seeing a world that is showing fragile economic growth out in the world. So that's where the main problems are coming down. And the main news stories that we do have here, we don't have much from the rest of the world. Bank of Zambia raises interest rates by 0.25%. As inflation remains sticky above the target range. We did see that copper jumped back up to the 8,300 as debt talks picked up. Gold and silver prices modestly went lower because of optimism on the debt talks, and also same with oil prices, up 2%, mainly on debt talks. There's some news also coming out that the Tazama pipeline in Southern Africa has also spilt about 6,200 barrels of fuel after a ruptured line, according to the operator, leaking low sulfur gasoline on the Tazama pipeline. That may not be good for us, because remember, that's what we're trying to use to bring finished product diesel into the country. So that may have an issue. So we just need to check on what impact that'll have at the end of the month on the oil adjustment. Other news that we saw coming out of Africa: average salaries in South Africa did rise, but slower than inflation, meaning real salaries have actually declined. African central banks are poised to hold interest rates while the IMF approves $3 billion for Ghana. Let's get into our big deep dive for the day, which happens to be our central bank story. Central Bank yesterday did announce the Monetary Policy Committee did make a major announcement yesterday that they are going to raise interest rates by they're raising interest rates by 0.25%. Remember that if you have a loan and there's an MPC factor to it, they usually say MPC plus, maybe it's gone up by 0.25%, or it may be adjusted by 0.25% upwards. So it may actually come into effect. It also starts to slow down some people's capabilities when they raise interest rates by 0.25%. Banks then concur by the margins that they do. And if that's out of your capacity to loan, you end up having to loan less, or you end up having access to less if you have access to bank credit. For those who maybe have indirect access to bank credit, you may find that those maybe who buy maize using credit may find that they have less money to go out into the markets and buy maize with those middlemen buyers. So those who use credit from the conventional system are going to find themselves having a little bit of an access point here. Main reason why they said that they're projecting that although inflation is going to be on the decline, and they have pushed down their outlook of inflation, it's still going to remain above the target band up until Q1 2025. Okay, where they're saying that it'll still be at 8.4%, and they'd like to push that into that. So they're going to try and aggressively also now get above that. They're also saying that one of the main things that will drive this is budgetary discipline and continued implementation of fiscal consolidation and broader economic reforms will remain important in anchoring inflation and providing macroeconomic stability. So it's not all the job of the central bank. They're also now announcing to the government to make those decisions, to make sure that they're balancing their budget as much as possible, and they're not driving huge fiscal deficits like before that led to runaway inflation, or potentially runaway inflation before. So that's what they're trying to do: contain the deficits of the country. Now, here's some of the main key stories that actually come out of the MPC announcements, of the MPR announcement. Inflation projection for 2023 has actually come down from 11% in the last MPC meeting, down to 10.5%. So that's actually good news for us. For actually trying, whether you're trying to gauge your business run or whether you're trying to gauge anything currently, that means that the rest of the year there's only going to be 4% more, effectively, of 4.5% of inflation added to the economy over the next 7 months. Or effectively over the next 7 months, based on what projections the central bank has. Because currently, year-to-date inflation is about 6.1%, so 10.5% means that we're only going to see about 4.1%, meaning we're probably going to have a deflationary middle of the month. But I wonder whether that will actually be the case, because our food production and regional demand may be quite strong. That might actually undo that. The other thing that we're also seeing is about 8.4% inflation for 2024, revised downward from 10.1% in the February 2023 forecast. Take a snapshot of this. If you're planning your business, if you're planning your outlook, whatever you're doing right now, these are the inflation figures that you need to start putting into your budgets. These are the inflation figures that you need to start putting into your investment targeting for this year. These are the inflation figures that are guiding the returns on investment that you should be targeting. Remember, the first job is 1, don't lose money. 2, beat inflation. Okay? All right? Remember the first thing, don't spend all your money. Beat inflation, don't lose your money. These are the 3 rules that you're going into when you're trying to invest your money. Don't spend all your money. Beat inflation when you're investing. Don't lose your money. These are 3 rules. So these are the inflation targets that you need to try and beat this year and next year, and looking for returns on investment that do. So if you've got, let's say, bonds that are giving you 15 to 16% return on investment, 8.4% next year might actually not be a bad thing, because you're getting 8% above inflation. So what is your target for your assets is going to determine. So this kind of inflation targeting kind of helps, because remember, when we had it at 11.1% and 10.1%, we really had to push people out to say, then the only credible investment that you had was the 3-year and the 5-year bond. These were the credible investments, because they were giving you 18.6% return on investment in the short run, in the short to medium term. Key drivers of inflation that we're looking at here are global food prices that are actually reducing, such as oils and fats. I'll show you the charts that are joining that as well. And high regional maize demand. This is an actual issue on the market. One of the things that's driving our prices of maize up is that the region really needs maize. And they're actually struggling with output. There's droughts in various places. Also, FX risk in the intermediate point. Companies like Zambia Sugar did say in their outlook they are concerned about the forex rate and what that'll have on fertilizer costs for them, what that'll have on various other costs for them. And then electricity tariff revisions are also quite important. But the other piece of information that we did also see was economic growth outlook. Economic growth outlook went up from last year. The projected economic growth outlook for 2023 is at 4.2%. It's 0.5% lower than where we were last year, meaning that the economy is going to perform a little bit softer than last year. But it's 0.7% higher than where it was projected to be. So 2023 projected economic growth is sitting at about 4.2%, when it was projected in May 2022 to be 3.6%. So we can see that there's been a bit more economic strengthening coming in. While for 2024, we're seeing 4.8% as stronger economic growth expected, which is up 0.6% from where it's going to be from where it's projected to be this year, and then 0.9%. So you got a growing economy and inflation that's going to start declining down. That means that we're getting into a Goldilocks scenario by about 2025. And 2025 is a sweet spot, really, because by then you've got your oil reforms that'll probably start to kick in. And you've also got your, you will also have your electricity reforms, which will hike prices quite strongly. But you'll also have some reforms in the fertilizer sector, which will also pull down FX demand as well. Key areas that are driving economic growth for the next 2 years are projected to be recoveries in mining and agriculture, obviously with regional demand. Information and communications has always been the main one. Manufacturing, transport has been the new one because it's one of the lead parts of the economy now. Fastest growing sector of the economy last year, and it was third biggest contributor. And mining has actually been shifting downwards. Financial services and insurance also will be driving economic growth there. So here's some of the things that the governor was talking about when he was saying that there are some declines in prices that are pushing outlooks of inflation down. As you can see, we talked about this yesterday. And if you can specifically see the green line there, which is trending down at 19% deflation, is the Global Food Prices Index by FAO. And then we're also looking at the Agricultural Index, which is the brown line, which is down 12.3% year on year. So we are seeing deflation in agriculture and deflation in food prices. We also have deflation in fertilizer prices as well, which is also adding to this. Energy prices are starting to come down, but you can see that they're starting to curve back upwards. So there is a little bit of an upwards risk starting to show into them. In terms of the money side of the equation, we did see that $377 million was offloaded by the central bank into the market. This is far less than the previous quarter, 15% less, and also 10% less than this same quarter, quarter one last year. So we are seeing less central banks selling of dollars in terms of into the market. We also did see our gross international reserves drop by 6.4% from the last quarter down to 2.9 billion, but they're up 3.5 billion than where they were last year. And we've seen that our import cover is now just slightly above the 3% benchmark. Remember, we were at 4.4% back when we got that 1.3% special drawing rights. Now we're down to 3.3% back where we were during the pandemic before we got those special drawing rights. So just around the time we got those special drawing rights. So we kind of are the lowest we've been since then, down 13.6% in terms of our import cover and 8.3%. So we have enough reserves to basically cover 3.3 months of imports in the economy, or about 2.8 billion. We're importing about 800 million. And part of the main thing we're seeing is projected imports in capital and consumer imports are key drivers to this. And I'll show you in trade data just now. But one of the main problems we're seeing is lower mining tax collection. Mining taxes, we got $187 million of mining taxes, up 1.2% from the last quarter, but down 55.8% from where we were last year in this quarter. Mineral royalties came in at 771.5 million, up 8.8% from the last quarter, but down 64.7% from the same quarter last year. And non-mineral royalties are up 8.53% in this quarter of $115 million, but down $47.2 million. Now, what will also maybe combat this is ZCCM now, also going forward, is going to be collecting 3.3% of all Kansanshi sales, and Kansanshi being half. So you can expect an extra 1.5% coming into ZCCM's account to also supplement mineral royalties. So we will see an increased dollar flow because of the ZCCM royalty deal. A more consistent dollar flow, because royalties are going to be paid on a quarterly basis, and it's going to be about 3.3% of that. And Kansanshi, like I said, being the biggest one, and ZCCM probably looking to restructure its deals along that way, will start to bring a stronger dollar flow to supplement mineral royalties a bit more. Now, remember, that'll only be about a quarter of what mineral royalties were getting, but it will at least create a significant bump upwards, because remember that mineral royalties is somewhere between 6 to 10%, and remember that we get about 6 to 9%, and ZCCM is only getting about 3.3% of the biggest, which is half of the production. So that should also help supplement some of the mineral royalties inflows that are projected to come in. Probably about anywhere from 50 to about $80 million a year coming in from ZCCM. That should add in about 20 or so every quarter. About 50 to 20 million that should be adding to the mineral royalties tally. That should kind of beef it up a bit, but it's not going to bring it back to where it was when the prices were really high and the trade and the volumes were really high, which was last year when we were getting about $200 million in the quarters from mineral royalties. That was where it was really impressive. But right now we're really struggling just to get back to $100 million a quarter. This is some of the trade data that I'm going to add to you. I showed you this last week. This is basically the fact that we've walked into our second deficit. This is also what's driving some of this as well. We're walking into our second deficit here of $135 million just in March. Now, I can also show you that quarter on quarter trade surpluses. Since March 2021, we're looking at about $1.16 billion worth of trade surplus happening in March 2021. But you can see that since December 2021, trade surpluses have been falling horribly. Now we're down to about $330 million in trade surpluses per quarter. And this is where the problem is starting to come from. having such weak trade surpluses per quarter, $333 million in quarter one and $315 million in quarter two. This is where the pressure on your FX rate is starting to really build up from weak trade positions. And where's it coming from? Very strong imports. The red line is showing you import growth, especially in the first 3 months of the year, January, February, and March. We're looking somewhere averaging around 30% year on year in terms of the import growth, while export growth has been in as was currently sitting at 17% in January because of a little bump. But if you're counting December, we've had negative month on year export growth in these months, meaning that exports have been weak. Imports have been accelerating, and some of the main drivers we're actually looking at here. If you're looking at Q1 trade, you're actually seeing that consumer goods imports are up 67%. Capital goods imports are up 55%. In terms of year on year for that quarter. The one that's still strong is raw materials, because those are the inputs that are costing still a lot. We have elevated commodity costs still in the global economy, but you have seen imports are up 33% on the quarter, while exports are down 2.2% on the quarter. So very strong import growth, especially even up to March. Very strong import growth is putting a lot of pressure, especially from capital. Capital is not such a bad thing, but the big concern to me is consumer. Okay. Consumer goods imports are up $835 million. They're outstripping capital, meaning that the Zambian consumer is recovering and they're importing a lot again. And this is what puts pressure on the FX rate. When the Zambian consumer is importing finished goods into the economy, that is where the pressure comes from. But remember, we've become accustomed to finished goods importing as a country, and then we're always exporting raw materials and not that much finished goods. Now, where things are getting a bit weaker in terms of export is coming straight from mining. Mining exports are down 20% in quarter one from where they were last year. That's where the problem is coming from. And you're also looking on the left here, you'll see non-traditional exports are up 70%. That's the part that's actually shining the strongest. Non-traditional, non-agricultural exports are the part that's shining the strongest. Alternative metals, while agricultural exports are up 27%, not fast enough for consumer goods exports to offset them. But we have had $222 million worth of agricultural exports in the first quarter. That's still putting it on track to pass $1 billion by the end of the year, especially when you have that tail end rally in there. But non-traditional exports are up 59.6% year to date in this one in terms of the quarter one exports. But it's the traditional exports that have been the huge letdown, that against the backdrop of capital and consumer goods. Consumer goods imports have been the real story that have pushed imports stronger and they put pressure. So it's the battle between getting copper out of this country and getting consumers to buy locally that's actually creating a lot of pressure on the FX rate continuously. So these are the charts that actually do back it up. And just to back it up here in terms of what we're seeing in terms of copper export earnings, you can see that we've now sustained below $500 million for 3 out of the last 4 months, meaning that we are really in a bad place when it comes to copper exports. That's what's leading to poor mineral royalties returns, it's leading to poor revenue coming in. Only $1.8 billion, as we've seen, worth of copper export in quarter one. So really, you can only get so much out of that. That's how our mineral royalties are coming in so weak. Now, adding to this, as we've seen that this is the chart that was shown yesterday that's showing the direction of our gross international reserves and how much import cover they are giving us. So that's why they're really low. They're the lowest they have been sitting at, and up to the point of when we got those special drawing rights back in August, which boosted us to about 4.4, almost 5 months of import cover. And we've been sliding down continuously as our imports have been recovering. So it's not really the amount of our reserves that have dropped. It's the recovery in imports that is declining this. So you can see that the reserve levels have really stayed very close to 2.9 to about 3.1 billion. They've stuck somewhere around there, but you can see that's where the problem has been coming down from. As just to get back to that, these figures I was showing you, 2.9 billion. We were only down 6.4%, but we're even up year on year in terms of our reserves. Now, Also coming into the market, we're also looking at our securities and our credit markets that we also picked up news from 159 billion kwacha as of the end of quarter one in terms of outstanding GRZ bond stock. It's actually down 0.9% and up 4% from where it was last year in that same quarter. So we can see that the government is slowing down on new bond issuance. So we're actually seeing the bond market starting to slow down in terms of its size, while we're seeing in terms of treasury bills, that market is up 10.1% versus last year. It was in the last quarter and 15.2%. So a lot of the growth in government credit is very short term. It's not long term. It's very short term. It's just in the T-bills market. You're seeing in terms of domestic credit growth, we did see that domestic credit grew 12%. Versus it's down from the 18% where it was in quarter four 2022, but up 11 point, it was at 18.7%, not up 11%. It was at 18.7% in terms of year-on-year credit growth in quarter four, and was 11.5%, meaning it's higher than where we were in quarter one last year, but lower than where we are quarter four last year. Main things that we're actually seeing is that private sector credit grew by 35.9% year on year, which is a bit slower than last year's. It's a bit faster than last quarter's 34.2%, but much faster than last year's 11.5%. And as you can see, public sector credit, in other words, the total amount of bonds issued to the government, or bonds and treasury bills, went up only by 6.2%, mainly because of the 10% growth in the T-bills market. It's up 6.2% year on year, and that is versus 8.9%. That is 8.9%. It was 8.9% up last quarter in terms of quarter four 2022, but it was at 43.7% growth in quarter one 2022. So you can see there's a big difference. There's a slowdown in government credit, and there's a ramp up in private credit, and kwacha value loans are starting to go up. So there's a lot of big business loans starting to go out again, and we are starting to see some of the data, especially in the quarterly loan disbursements, starting to show that there is loan growth moving. Money supply growth, this is where I think there was a lot of inflation risk that came in. The money supply grew by 30%, mainly because of loans and revaluations. Those are the main things. We saw 24% growth. We saw this versus 24% growth in quarter four last year and 17%. So we're having an accelerated money supply right now. So quite a bit of money is going into the system. In addition to this, I think you've also got billions going in from NAPSA, billions going in from repaying suppliers. You got about 4 billion that's gone in from NAPSA, 3 to 4 billion that's gone in from unbundling old arrears with suppliers, and then you got ZNFU payments. So you got huge chunks of money that are also coming in. So these are the things that are building the inflation pressure already in the system, that also have to now push the central bank to say, we need to cool things down a bit by also pushing the interest rates down. So they have to use the tool that's made available to them. They've tried to clamp up bank positions, but they have to now kind of slow down the loans market. As you can see, 35.9% growth in the loans market still means it's very strong. So what they're trying to make sure of is that when they're raising interest rates, there's still credit growth. If there's still strong credit growth, this to me signals there are still a few more hikes along the way. There's a central bank that is pretty much going to push the interest rates up along the way until we start to see this credit growth come down. I'm not foreseeing the central bank pulling down rate hikes anytime soon, because I think this is the key figure they are looking at that is going to signal to them whether they should slow down on interest rate hikes or not. So in the future, still expect interest rates to continue going upwards. Okay, that's important. That's important information for you to try and grapple onto here. Now, this is just some of the credit growth numbers. You can see the one in blue. That's the credit growth. That's the credit growth chart itself. You can see that's the private credit growth. So you can see private sector growth is actually now starting to drown out public sector. While for the last, especially from March 2020, public sector was drowning out the private sector, and you could see it push down in all the way up to 2021. But there's been a private sector credit recovery since the middle of 2022. So this means that for the big businesses, there's more cash on hand. You're seeing it, by the way, even in the books of some of the listed companies. They're starting to show this. By the way, this is strong news for listed companies. Okay, this is actually quite strong news for listed companies. So if you're trying to look at your stock portfolio, part of what you need to pay attention to is that there's a high likelihood that this is going to cause, this is what trickles some of the growth in the rallies that happens in the stock market. So prep yourself, because now this is where you need to start transitioning. Even I've started to now start to itch a few clients to start saying, right, you're doing the bond buying spree, continue as you're going along, but we need to splinter some of that money into the stock market now and start being selective about some stocks to start picking, because there is credit flowing into these companies. And when there's credit flowing into these companies, it does mean that there's an opportunity for growth, for these companies start giving better than expected results. The problem is when the credit they're accessing becomes too expensive and they start getting credit contractions, their expansionary activity starts to slow down. But we're starting to see listed companies, CapEx spending is still up. CapEx spending in listed companies is still up, especially from the 2022 results. We're seeing capital expenditures are still up in listed companies. We're still starting to see them that they're still doing expansionary activities. So that means that's good signs for their growth in the future, especially with inflation coming down in 2025. 2024 going into 2025. So if they've expanded their capacity by then with a lot of cheaper credit, then you'll probably see that you'll probably see that their sales growth will start to trigger their profit growth much stronger down the line, and especially with the financing costs that won't be too high. This is where our second our securities industry is starting to look. Our government securities industry, as you can see, contractions from December 2022 in the government bond space, while our treasury bill space is the one that went up. But if you're looking from March 2021. From March 2022 to March 2023, that's where you're seeing quite a strong leap. But if you want to see where the big growth was happening, it was before March 2021. You can see those were huge movements in GRZ bond issuance, huge movements due to the private raisings, due to the paying of suppliers using government bonds. There were huge movements trying to bail out the banks using government bonds issued to government suppliers, so that they could now trade those, inflating the bank's bond position. All that happened between the second half of 2020 to the first half of 2021. So that's why you've seen that huge bond position. That's why I always cite that 78 billion kwacha worth of government bonds were issued back in the 12 months between June 2021 and June 2020. Those 12 months were the biggest expansion of the government bond market that we've ever seen, and have resulted in the size and scope of the government bond market that you're seeing now, all the way up to September 2021. And pretty much since September 2021, you've seen the government bond market stay very close to where it's been. Maybe it's risen by about 10%, but it hasn't done the 100% runs that it did before. Then Treasury bill market has pretty much been stuck between 35 and 40. It's also sitting at its highest point, but that's because the government is just skewing towards issuing one year Treasury bills and then paying those back as quickly as possible. Now, key data that we also did see that the governor did mention is upside risks to inflation that he's keeping an eye on are further delays in credit negotiations. That's going to affect the exchange rate. Tighter global financial conditions. That's due to interest rates still being hiked by the Federal Reserve and other mainstream banks as well. Higher maize prices due to anticipated lower production, and also strong regional demand. So we are struggling to produce. Floods, all sorts of things are impacting our production. We're also not getting our fertilizer out. Probably remember that we're also trying to switch to producing fertilizer. Fertilizer has been expensive around the world, so we're also trying to control the impact that has on our FX rate. So going forward, we're looking at probably a better yield somewhere. Again, 2025, 2026 is starting to look like when most of the rosy picture starts to pick up again. And I know that's politically tied up, but that's the way the cookie crumbles. Get yourself prepared for that, because that looks like where a lot of the optimism is probably aimed towards, because that's when your fertilizer deals are coming through, oil deals coming through in 2026. A lot of your production capacity in maize will probably start to pick up again around that time. That's where a lot of the business is happening here. But right now, there's a lot of preparatory work. So it still looks like bonds are a strong game, but somewhere towards the end, somewhere going into next year is where you start to see the stock market pick up again. Now, that doesn't mean that there won't be some stocks to pick up now. This is obviously a time to start rotating. Rotations have to start being looked at now. And he's also talking about the impact of a prolonged Russia-Ukraine war. So these are the inflation upside risks, growth downside risks, the things that could pull growth down, slower global growth, the expectation that the world is going to grow at a slow pace for the next at least 2 to 3 years, that is coming down the barrel. Projections by the IMF are showing that growth is pretty slow. Chinese growth specifically has also slowed down, but it looks like Zambia and China are starting to decouple a bit, especially due to our trade lines. So if we can continue the decoupling, that might help us out. Tight global financial conditions also will slow down global growth. Adverse weather conditions, which might affect, like floods, have affected our crop output. That ends up affecting our agricultural recovery. And elevated energy and food prices. Now, currently, that's not too much of a risk because those are starting to deflate, but there's always still shock risks that can play into those factors. So those are some of the main things that you have to keep on your mind as you're looking at that. That was the roundup coming from the central bank. Some other news that came out yesterday is that 11 central banks in Africa are actually poised to potentially hold their rates. Okay. So 11 central banks are set to decide on monetary policy, some of them being Egypt, Mozambique, and Kenya. And most of them are actually deciding that they're going to hold rates because they're seeing energy prices stalling now. And they're also seeing unwinding of supply chain constraints and food prices starting to come down globally. So you have got African central banks that are set to start to pull down energy rates. And we also saw yesterday that the IMF approved a $3 billion facility for Ghana to revive their economy. They will receive about $600 million immediately. This came off the back of the cedi being the world's best performing currency against the dollar in the past 6 months, based on the fact that they now started to engage the IMF. So that pushed their currency up. Ghana took some strong decisions, including tax increases, to try and make sure that they can get this deal to go through, because they were literally sinking. This came off the fact that before that, the cedi was the worst performing currency, and they were in a spiral during that period. A chart of the day is something that was shown yesterday by the minister, by the governor, which has been where African currencies are under pressure. And as you can see, African currencies as a whole, and this concurs with why the dollar has strengthened a lot in the last month, but the rand has actually contracted. The South African rand is down 1.2%. That's a mix also, but other African currencies are also facing this. So this is a blend of how African currencies are looking versus the US dollar, and you can see that they're consistently weakening, and it is the Federal Reserve raising interest rates plus the Russia-Ukraine war. These have really put pressure. Exchange rates of average currencies in Africa. This has really put pressure and has weakened quite a lot of African currencies, especially through 2020, 2023, 2022, and 2023. And you can see this is it's a continent-wide issue because risk spreads are actually widening. Emerging markets countries are actually performing quite decently. And here's some of the data to also support this, is that there's also a chart that comes out of Bloomberg, which is showing that emerging markets are starting to look cheap compared to developed markets, as it has done this century. Spreads between the emerging markets, the MSCI World, over the emerging markets price to book multiple is showing you that it is much cheaper to actually buy emerging markets. And as we're going along, especially after China's devaluation, COVID, you're starting to see that emerging markets are getting cheaper and cheaper. This chart in blue rising, is actually indicating that it is much more of a bargain for investors. So meaning that once we get past the kerfuffle of what's happening right now in the global economy with rising rates, debt ceiling talks, and most of the things that are slowing down, most of the investors are going to be looking to outside. Currently, they're buying their bonds domestically because this is the first time they're getting 10-year bonds with 4% return on investment. They're looking at it saying, when inflation comes back to 2 to 3%, if I've got 10-year bonds with 4 to 5% return on investment sitting in my hands, that means that going forward, after this whole inflation mix for the first 2 years, I'm going to be getting a 2% positive return on investment, positive real yields. So that's why a lot of US investors are packing their money in to as many instruments as they can in their domestic markets. But the moment they go back into a expansionary growth cycle by their central bank, you're going to find a lot of that money parking itself outside. And already we're starting to see US global hedge fund managers and investment managers are already starting to push money into the markets abroad. So that's some of the signals that we're seeing, that if we get our debt situation sorted out, these are some early signs that we actually could have a positive run on our hands and could be beneficiaries of it, especially 2024, 2025. Once we can get past the recession bump that'll happen second half of 2023, going into 2024, and then you can actually start to see quite a lot of capital come in. So if we can clean up this whole mess before the end of this, before the first half of this year, it actually brings a lot of stimulus projected to come in the first half of 2024. So that's where you can actually start to pick that up from, because they are going to go through a recession. They're going to consolidate their positions. Once they do that, the Federal Reserve is going to pump it full of cash, and off they go back into the global economy to push money into the global economy again. It's pretty much a cycle that has continued for decades. It's not going to stop anytime soon. So prep yourself for it. That is probably now, once you start to see, and it's always a trickle effect. Once they get into your bond market, interest rates come back down, pushed into big companies. Big companies have a lot more capital to expand their sales and business activity with. Once that happens, and a stronger currency to import inputs with, once that happens, you get strong sales growth in these companies with minimal financing costs, higher gross profits, pushes up the equities market, and that's how the equities market runs up again. So in the outlook, we are seeing a lot setting up for the equities market to take off once you can get past the hurdle of debt. But that's a big once. Okay, that's a big once that does that. But of course, you do still, that could happen a little earlier. Projection for me is that's probably going to happen in the first half of 2024, not the second half of 2023 like we had looked for. But we're probably going to see it in the first half of 2024, because obviously these banking crises that have been happening in America, and also these debt ceiling talks, have really stressed their economy. They've stressed their financial system. So that's pretty much the roundup of that. And thank you for everyone who's actually been with me this morning. Time to quickly take a look into our topic of discussion. And our topic of discussion today, and by the way, this was just also to add into what our chart of the day was, but our topic of discussion today is finding your market. And this is a conversation that many people have called trying to find founder market fit. So this is for entrepreneurs out there, because whenever you do have when you have inflation that cools down and economic growth that goes up, which is what we're seeing in 2024. Okay, that's the expectation of what we're going to be seeing in 2024. An economy that's going up in terms of growth from 4.2 to 4.8% higher than where it was this year, and projected to continue staying around 4.7%, one of the top growing economies in Africa, especially outside of East Africa. And a projected inflation that will now start to curb down to the 6 to 8% range. Hopefully, finally, we can get there. We've been out of the 6 to 8% range, by the way, since the end of 2019. Zambia has not been in the 6 to 8% range of inflation since 2019. This is how bad the situation has been. We have not had 6% inflation annually. 6 to 8% inflation annually for almost 4 years. Okay, that's where we're sitting. Since 2020, 2021, 2022, 2023, we're literally sitting in we've been sitting in double-digit inflation, or at least above 9% and above, for almost 4 years. And that's not been good for our economy. But we have seen economic growth at least still coming into the economy. So we just need to get out of that cycle. That, I think, is the rut. We need to get back to that 6% range. But there's a possibility by 2025, we're finally looking back in that 6% range. But that should be that we don't meet a shock. The only problem that's been doing that is every year a new shock hits the market, whether it's COVID, whether it's central banks, then it's the Russia-Ukraine war. Each year, a new stress has just hit the global economy. So if this is the last stress, I think we can finally start to see this start to tail off, the recession play out, and then we move on from here. But let's take a look at the first one, finding your fit. Now, over the next couple of weeks, over the next series of weeks, I'm going to be going through each of these sections, from founder market fit, problem solution fit, team vision fit, product market fit, market business model fit, and brand culture fit. How to actually take this journey of each of these things, especially for those of us who are trying to build businesses in this area. These are journeys that we're all trying to take as well. The first one is finding your fit. Today, we're going to have a brief look at it. And this is a conversation that I'm going to go through an article by NFX, who are a venture capital firm who really use this to target the founders they really are looking for. And there are 4 components of founder market fit. You want to take these down, by the way, of what they look for in a good founder of a business. In other words, are you the person to find? And those 4 components are obsession, your story, your background story, your personality, and your experience. So before you start a business in an area, now this is just something they look for. Now, no one says you have to or don't have to, it's up to you. But this is just what they're looking for. And just to give you an idea into the inside of what we call an investable business, the things that drive you is the obsession with the problem, not the obsession with the technology, an obsession with the problem. Okay, it drives you almost angry. You have a personal history with it, a personal experience that has an emotional attachment to you. It drives you emotionally. You have the personality that fits into that industry, and you have experience, some level of experience in that industry, not too much. Okay, so the first one being obsession is that people have to start something that they that and in the statement that they say here is, I often tell founders, don't start a company unless you cannot do it, unless you cannot sleep at night and your brain is exploding with that idea, like it's becoming an obsession to you. um, I sleep at night at the end of my headboard at the end of my bed with a whiteboard, with most of the stuff that I've written out for most of the market and the business that I've got there. So yes, and I sleep at very late hours, sometimes crunching stuff. So I think I've gone past the point of obsession. But yes, it does need to be an obsession, because the people who are obsessed with problems are the people who work on them the longest, the people who work on them the hardest, and the people who persevere through the issues. Those are the people. Obsessed people tend to do things that non-obsessed people are not willing to do, and that's what makes them outlast, out earn, and outperform them in the end. It's the kind of things that they're trying to look for. When time is passing, what are they doing? And you do find that people do carry a very strong obsession for one of the things. Now, one sign of healthy obsession is the level of knowledge that a person has in a field or in something. Now, it doesn't mean that that's the only sign, but I'm just saying when a person just kind of knows every competitor, knows every number, knows every this, they seem like they're stalking the industry. Okay, that kind of signals to anybody that you're dealing with a person who is investable in that perspective. So that level of obsession actually shows. Now, people who studying the market from a distance is not to be underestimated. Founders should be talking about should talk to 10 to 30 practitioners and experts who have done something relatively similar. So if you want to start a business in an area, have you talked to people? Have you hung around people? Have you worked with people? That kind of helps you start to understand the competitive landscape you're going into. Don't obsess over this point too much. I know it's counterintuitive, because if you stay here, you end up not taking action. But a lack of obsession and a lack of knowledge is almost always a bad sign for most people, even whether they want to invest in you or not. And this is not what banks are asking for. I'm just telling you, this is what leads to you being an equity investable company or building one. If you go into Dumisani Ngube's Radical Entrepreneur book, he talks about this as well. He talks about know your game and know your competition. He knew the numbers, he knew this, he knew the clients, he knew how much each wanted, because he was so obsessed with how the industry was doing. He was very, very obsessed with what he found there, and that's also what drove a lot of his success in the PVC card printing business. Now, another point that we do look for in terms of your founder market fit is your background story. Do you have a personal story with it? Did you interact with this problem? Do you have a sibling, a spouse, somebody who went through this? I remember there was a story about 2 guys who started an application for for ordering supplies for veterinary business, because their father was a vet, and they used to see how irritating it was for him to actually order supplies as a vet. And so that unique insight they had into that actually drove them to say, you know what, I think we need to solve this problem, because we remember how dad used to suffer with this. So people who do it, when you talk to the founder of the first taxi app in Zambia, he tells a story about how his sister was sick. I think it was his sister who was sick, and they tried to get her to the hospital. And that was the key driving force that actually made him go out there and actually start an application, because of how difficult it was for him to book a taxi. Do you have a similar emotional appealing story that kind of drives you, because that memorial of that story is what's going to drive you to work those hours to actually develop that idea and to push yourself to it. So a personal story that kind of drives you to do something, it makes you connect with something very strong, as well. Whether it doesn't have to be you specifically, it can be a friend, it can be anything, but something you have had a personal interaction for makes you see an opportunity in a market, but it also makes you feel the pain of the customer. So if you have a personal story of the customer's pain that led to that problem, where you've personally experienced that problem, whether it's a bond bid, like for me, seeing the cycle of retail investors trying to go through bond bids, that thing was painful. Seeing people get rejected the way they used to. So it drove me to say, look, people need to get an education on all of this. And we also need to make sure that we actually clean up the process for them and take them through it much easier, give them a community. So these were the things that drove that kind of push. Personality also matters, because it also asks the question: are you able to network in that society? Because you're going to have to network in an industry to access opportunities. You're going to have to network to partner with people. So does your personality match or gel with the kind of people that are already in that industry? I'm hyper analytical, so whether I'm rebellious in one side of my personality, I'm also hyper analytical. So because of that, a lot of the people in my field are very numbers oriented and analytical, and it kind of gives me opportunities in the space. I understand the system from a very technical perspective. I'm very risk and technical oriented, so it does open a lot of doors for me in my own industry. So what personality do you have that allows you to network in your industry? You have to look at that, because 15% of your success is going to be your technical skills. 85% of it is going to be your personal and social skills. Are your social skills injured by the fact that you cannot navigate amongst the people of your industry? Because yes, you'll have all the customers and all these opportunities, but no one will want to work with you, no one will want to supply you, no one will want to do business with you. The final thing you want to look at when looking at founder market fit is your experience. Now, you don't want to have too little experience that you know nothing, but you also don't want to have too much experience that you are hampered in how to think. So they do give some basic backgrounds that if you're going to start a consumer business, you really want to have about 3 years of experience. If you're going to have a B2B business, you want to have about 5 years of experience in that area. And then if you're going to go into something that's hyper technical like bio or healthcare, you really want to have about 7 years of experience. That's pretty much what they've said. Your disruptive potential is somewhere there. So you don't have too much experience, but you also don't have too little experience. Ignorance is often an opportunity for 1 out of 50. Knowledge is an opportunity for 1 out of 5. And too much knowledge is a blocker to innovation. Okay, so that is what you really want to see out there. So for those of you starting, those are the 4 principles of finding your fit. One is have you found a problem in your industry that you are obsessed with? Like it's there's an industry there, there's customers that need to be served, but there's a problem with the way they're doing it. Have you experienced that problem vicariously or personally, and have you seen the emotional impact of that problem? Do you have the personality that allows you to navigate with all the people in your industry? And 4, do you have some experience so you understand the competitors, know the customers? Because those are the first 2 of the 4 radical steps. Even to be something with the points that know your client, know your customer, know the game. How does this market work? What are the ins and outs? What are the engines? Where do people source stuff from? Like, have an obsessive knowledge as to where the stuff comes from. And then also, who is the biggest player? What is the faults they have? Where are their weaknesses? If you know this stuff, that's an obsession that drives you to know the game, and also experience that also gives you an open eye into those areas. Then you can take the radical steps of starting small, implementing. Those are the other steps that he pointed out in there. But if you want to really look at that, that's a book that you can obviously see it in. So to everyone, I wish you a wonderful, wonderful day. I know that we've really driven over today. Hope you picked up some information for today, and we'll be talking tomorrow on Futuristic Friday. Have a good day. God bless.